We did it. We surpassed 14,000 subscribers here at PPCE, and this is a community of like-minded investors. We invest for dividends and cash flow. This is a community, a YouTube channel about earning passive income from dividend checks, money that flows in literally while I sleep, that can be used to pay the bills. I'm documenting my personal journey here. I've been investing for over 20 years. I am all in on the dividend strategy, and one day will pay for all of my bills with dividends. And today's video, in celebration of 14,000 subscribers, I want to go into three questions that I've received recently from subscribers. The comments here are so amazing. I get so many good questions, and the comments below, it's literally one of the greatest ways you can thank me for this channel. So anyways, I want to jump into it. I want to jump into these questions, and I'm actually going to start off by disclosing yet another position for my personal dividend stock portfolio. So I get this question, hey Ian, I know you own a lot of consumer non-cyclical stocks. I know some of your other holdings, you've shared them over time. I'll link in the description below, by the way, to some of my videos, my playlists about my favorite stocks that I own in my personal portfolio. But I got a question like, Ian, what do you think about the transportation stocks? What do you think in particular about the railroad industry? This is an old school industry. Do you invest in it? Do you not invest in it? And I actually do. I own a railroad stock. I own a company called Norfolk Southern. This is ticker symbol NSC. I bought this stock back in 2013, and this is an interesting one. It's such an interesting stock because the current dividend yield, it never tends to be that high. In fact, the current dividend yield right now in Norfolk Southern is 1.78% right now in 2018. And so not a very attractive starting dividend yield, but I'll tell you, I bought this thing back in 2013. And I've done really well on this. But before I get into that, I want to share why I bought this stock. Why do I invest in railroads? Well, first and foremost, I like the diversification. I like having a transportation company. I like having a railroad company. It is a great way to diversify my portfolio that tends to have companies in the consumer non-cyclical space. The other reason I like railroads so much is there are just such barriers to entry. Right now in 2018, there is not going to be, in my humble opinion, a new company that all of a sudden comes around and builds a railroad. Why is that? The land is gone. The land is all owned, and the railroads, they already have their tracks laid. They have the land that they need. They have the infrastructure in place. So just think about that. Coming now in 2018, a disruptive railroad, some new company, are they going to come along and go ahead and build all these tracks, acquire all the land, all of the rights, all of the easements that is necessary to do so? It's in my opinion, impossible. And so I like industries where there's a competitive moat. I've talked about regulated electric utilities before. One of the reasons I like those is there's a competitive moat. Perhaps though with the railroad industry, there's even more of a competitive moat. I just don't understand how a railroad company could be displaced. And obviously in a world that relies on items, we rely on materials for building buildings, we rely on food, we rely on gas and oil, we rely on all types of stuff. The railroad is a pretty efficient way of shipping all of these goods across the United States and across the world for that matter in different countries. And so for that reason, I really like the railroad because it's effective at what it does, and there's just a huge competitive moat, and so I don't see it going anywhere. Anyways, I bought Norfolk Southern. I got lucky. I bought it for $74 and change in 2013, and it's gone up and down over the years. There's times when I actually remember that I wasn't doing so well on Norfolk Southern, and this is the fun thing about dividend investing. When a lot of people invest in a company and all of a sudden it goes down or they lose money on paper from a capital appreciation standpoint, they tend to think like, hey, I'm not doing very well. This is very frustrating. This is, should I sell? Should I sell my stock? This is something I've had to condition myself to have to think completely differently than others out there over the years. But when I own a dividend stock, if it goes down, even if it goes below my purchase price, I do not get scared. I do not run away. Oftentimes I think about buying more, because if I liked a stock at a certain level and it goes lower, I better like it a lot more. But most investors out there, many investors out there, especially newer investors, and look, I've fallen into this trap myself when I was in my earlier days, they tend to get scared. Anyways, Norfolk Southern, this is a perfect example because I bought it at 74. For a while, there were some ups and downs, and I actually recall at one point I may have even been underwater on it, and so boy, it is good. I did not sell. I resisted that temptation. I have learned my lesson in the 20 years I've been doing this, because fast forward to September of 2018, just 5 years later from when I purchased it, it's at $186.71. And so when I take the new price, subtract out the old price, divide by my original price, the gain that I received is 152%. In just 5 years' time, I have earned, in terms of capital appreciation, 152% on Norfolk Southern. Now, I don't invest for capital appreciation, but I'm sharing it here because I get a lot of comments like, hey, Ian, should I invest in dividends? Because I don't think these dividend stocks go anywhere. Ian, I hear that these dividend companies, they pay a dividend, that's nice, but you can't earn any money on capital appreciation. I've shared some recent examples in other videos. I'll link in the description below. I shared one recently where I've just had a jackpot style gain, but this is another one. It's not a jackpot, but it's pretty darn good to receive 152% gain, capital appreciation gain, in just 5 years' time. This, and with a very traditional company, a railroad, an old world company. And so this is totally possible with dividend investing. And yeah, I share a lot of my successes here on my channel. Obviously, I've had mistakes and failures as well along the way. And so don't get me wrong, I've been through it all, but I like sharing some of these successes because it points to everyone what is possible with dividend investing, and that it's not a boring practice. It's not a practice that yields no results in terms of capital appreciation. In fact, the capital appreciation is there, and it's a byproduct of these companies, a lot of the companies that I own, doing so well. Anyways, my yield on cost for Norfolk Southern is 4.3%. Not huge, but not bad for a industry where the starting yields tend to be really low. And so when I bought, starting yield was low. They've raised the dividend a bunch. In my opinion, they will continue to. They have room to. It's a very cyclical industry. It tends to be boom or bust based on the economy. A lot of what's being shipped on railroads are equipment, automobiles, actually, cars, construction materials. And so obviously in an economy like we're in now, there's a high demand, but in a coal is another one. The railroads have benefited quite a bit from the Trump administration, from the resurgence in the coal industry. And so a lot of these railroads, especially Norfolk Southern, they ship a lot of coal. And so again, there's a boom and bust though to all of this. And so what has happened with Norfolk Southern and other railroads is over time, they have tended to be very conservative on their payout ratios, on increasing their dividend. And I am fine with that because I don't want to have to face a dividend cut. I prefer them to be very conservative. And that's why my yield on cost after 5 years is only 4.3%, but still a good yield on cost for an industry that, in my opinion, has very, very little perspective of any kind of disruption coming. I just don't see it. And so that's it. I own that stock. In terms of full disclosure, I am long. I own Norfolk Southern in my personal stock portfolio. I own that one, and ticker symbol NSC. And so thank you to whoever asked that question. That one was actually from a while ago, but I'm glad that I finally answered it here, because no, for me, it's not only about consumer non-cyclical. Quite frankly, I have so much money historically in the sin stock vertical within consumer non-cyclical that I'm always proud just to branch out and have something different like a railroad company. It helps me sleep at night, and if I can make 151% capital appreciation in 5 years on it, that makes it even more great. That's the gravy. Now, I will tell you, especially for newer people here on my channel, I do not invest for capital appreciation. I literally only invest for dividends. I never plan to sell. And so this 150% gain, yeah, that's nice. I like it. I'm happy about it. It's a reflection of a company doing well. It's a reflection of me picking a good stock at a good time and timing it right, all that good stuff. But it's never going to do me a lot of benefit other than the fact that it's kind of a secondary measure of the company growing, the company doing well. And as a byproduct, they will probably continue to raise the dividend. But for me, I literally only invest for the dividends. And so what's most important to me is that yield on cost coming in at 4.3. Happy about that. And so really, really happy about that. And boy, the railroads are a weird one. It took me forever to get into this company. Historically, I always wanted to get into Union Pacific. I never did it because it always seemed too expensive. It's one of these stocks, always too expensive. Same with Norfolk Southern, always seemed too expensive, but I kind of finally found an entry point, just went for it. But I'd be curious, what are your opinions? Put them in the comments below. Do you own railroads? Do you not? Do you find it a weird industry, kind of like I do, where it's always hard to get in at a good price, good starting yield? It's just, I certainly at a 1.78% starting yield right now, I have the same thoughts go through my mind if I were buying a net new position in Norfolk Southern today as when I first started back in 2013. It's that same dynamic where those starting yields are always really low. So I'd be curious what your opinion is. I am reinvesting my dividends in Norfolk Southern, but at this time I'm not buying anymore because I do believe it's come a long way. It's cyclical. I think we might be towards the peak of a bull market, and so we'll see what the future holds. But it's actually a real strong medium position in my portfolio. A good chunk of my portfolio is now in that company because it's done so well, and so I'm going to let it go. I'm going to let it ride. And you've been here a while, you know I never sell or very rarely sell, but I am reinvesting dividends even at this level, because I believe in the company, and I want to see where it goes from here. So that is subscriber question number 1. I want to go into the next subscriber question now to commemorate again 14,000. Thank you guys. I'm just so honored to have 14,000 subscribers here, and just wait till we get to 100,000. That's where I will share my entire portfolio, and I will share all on a percentage weighting basis how much I have in each stock in the portfolio. But if you've been here a while, I've disclosed many of my positions by now, such as the Norfolk Southern one I just shared, and you've probably picked up a lot of them already. But needless to say, at 100K, it'll be really exciting. So moving to the next question, I got this question recently. I want to share it because I'm passionate about this. I am so passionate about this because it's a controversial topic, and the topic is like this: Ian, is a homeownership, a house, is it an asset or a liability? Boy, one of my favorite authors, financial educators of all time, Robert Kiyosaki, the Rich Dad, Poor Dad guy. I have all his books, or not all, but most of them, I would say. Love his books. And he always talks about a house is, if you're not renting it out, like a house that you live in, is a liability. And why is that? It takes money out of your pocket. It takes money out of your pocket. It's not paying you a net cash flow the way dividend stocks do, or the way that a rental property properly managed would have the potential to do. You get a lot of people talking on both sides of the equation. But I think the common answer these days is a house is a liability, not an asset. I actually take a different approach, and I'll link in the description below. I recently did a video from Las Vegas. I shared my experience in the Great Recession, how buying our first home during that time was interesting because I had sold a lot of my stock portfolio to fund the down payment, and right after that, we bought our house, and right after that, the market tanked, and then I started rebuying my portfolio. I got a bit lucky on the timing, but that said, I just shifted assets from stock market to a home, and so all assets are influenced by the ups and downs of the market, and so I was lucky in the timing in some respects, but on the home side, maybe not so much, because it was towards the peak of that market. Anyways, I'll link in the description below if you want to learn more about my experience around that time. A lot of good insights in that video, but we are in our second home now, and I truly believe that in the right circumstance, it has to be the precise right circumstance, a house is an asset, a home is an asset, not a liability. And let me explain my criteria for that. My criteria, well, first, before that, I look when we bought our home here, it was in circa 2013, and I look at the value of it now. We're in the Bay Area, very hot market, very good market. Always, in my opinion, going to be demand around here. And in my opinion, we're up roughly 62% the value of the home over these 5 years. Now, the benefit of that appreciation is even more multiplied because of the concept of a mortgage or leverage, because it's a 62% gain on the total purchase price. But if I just look at equity that has been put into the house and then extrapolate the gain on the equity put in, it is more. It is substantially more because of the concept of leverage with home ownership through a mortgage. And so the fact of the matter is, if someone buys a home in the right market, right now, in my opinion, I don't know if it's the right market. The market has come up a lot. Was it the right market back in 2009 through like 2013? Yeah, that was a really good time. And so a home, in my opinion, can be an asset if it's purchased during the right time. I also think geography matters. There are certain markets like the Bay Area where there is just a shortage of land, there is not enough land, and there is demand that far outpaces supply. There are other parts of the country and the world where the land is just vast and new homes can keep getting built and built and built. The land will basically never be exhausted. There's always enough supply of land. And so in the first situation where it's an infill market, the home is in a very central location, in a location where there's a real shortage of supply of land, there's a huge demand, I think a home can be an asset. In a market that is more blue ocean opportunity, there's a lot of land, there's a lot of parcels available, and the new home builders can just build and build and build, I would say maybe the house is not such an asset in that case. What else? I like home ownership from one other perspective. In my opinion, if one has a traditional mortgage, a 30-year fixed, for example, and it's not an interest only, it's a traditional mortgage, there's an element of forced savings there. I like that. Each month, when the mortgage gets paid, part of it goes to interest, part of it goes to pay down principal. I like this because it's just another vehicle that forces savings. And so if you're like me, you like to save money, you like to invest money, you like to build your wealth over time, I think a home could do that if one is diligent and faithfully pays their mortgage payment each month and has a traditional mortgage. I like that forced savings element because it gets that forced savings in the equity, and it's an appreciating asset generally over time, again, if one purchases in the right market at the right time. So get this example, actually, I'll link in the description below some kind of tech stock versus dividend stock examples. A lot of people in tech stocks, they're like, Ian, I like to buy tech stocks. I like to see them run. When they get to their peak, I'm going to sell them, put all the money in dividends, live off the dividends. Great. I think that's a cool strategy. The reason it doesn't work for me is I want the ability to tap into dividends at any time, including tomorrow. And for that reason, my dividend stocks are in a traditional individual taxable brokerage account structure. And so because of that, I can't really do this growth stock thing as illustrated in this particular example, because when the growth stocks go way up, there's this premise of not having to seamlessly transition into dividend stocks. And that's possible with a retirement account, because retirement account, it wouldn't trigger a taxable event. In an individual structure, it totally would trigger a taxable event. And so because I want the ability to tap into my dividends tomorrow, because I generally like to buy value, I feel so much more comfortable buying value, and because I don't want to wait. I don't want to have to wait for traditional retirement. I want an early retirement. This whole get the growth stocks, hope they go up more even though they're at really high valuations now, and then redeploying to dividends. It doesn't work for me, but I know some people speak of this. They think highly of it. They've even done this. Good for you. Great for you. There's so many different ways to invest in the stock market, so many ways, and I respect all of them. Anyways, I look at home ownership kind of like that exact scenario. If one buys a home, they buy it at the right place, they buy it at the right time, it goes up, like I believe, the value of our homes probably up about 62% in 5 years. You never know. Real estate market is illiquid. You never know what kind of offers you would get, but ballpark. Well, what does that mean? That growth in the value, if we were to sell, is also reflective of growth in the ability to charge higher rental rates. And so this will probably not happen, but let's say at some point we decided to move into another house, we decided to purchase a new property. We could leave this property and consider renting it out. And the rental rates extracted will be far higher than they would have been back when we first purchased, because the market has changed since then. The prices are up, the rental rates are up. And so I kind of look at home ownership from that perspective. If one gets in, right place, right time, it goes up in value. That person maybe later is able to move into something else, maybe even something cheaper, maybe even something in a completely different area. And I struggle with this concept of geo arbitrage. For the longest time, I said I'd never do it. At this point, I'm a little bit more open to it than in the past, but still have a long ways to go to get my hands fully around it. But let's say there's this geo arbitrage, move into something in a more affordable area for less money. Well, that asset that one bought could be rented out and could be potentially a good cash flow vehicle and investment. And so that's truly, in that case, an asset. And so when people just say, hey, a home, it's a liability, it's not an asset, I really challenge that. I totally think a savvy home buyer can totally look at a home as an asset. And of course, this doesn't include the quality of life stuff. I think by owning a home, it improves one's quality of life. If you're like me and you like to do a lot of projects, like in the backyard, you like to do a little gardening, you like to just do stuff in the house, like little projects, big projects. I'm the kind of person that has a hands-on approach. I like to do projects. I'm by no means like a construction expert or from a construction background, but I picked up a few skills over the years. I continue to learn. And just simple things like hanging like racks like in the closets, or hanging some hooks on the wall, or building furniture, painting, doing all kinds of little things like that. It's just kind of a fun activity, at least for myself. And when one owns a house, they feel this sense of accomplishment by doing these activities to make the home an even more inviting environment. Whereas a renter, they may not want to do those types of things because they're putting all the effort into something that they may, even if they don't want to move, they may have to move at some point because maybe the landlord decides to repurpose the property or decides to really raise the rent to a very high level. All of that kind of stuff. So the last thing about a house that's really exciting is I get a lot of questions here, and I've done a video, I'll link in the description below, about inflation. It's debatable whether there's inflation or not. I kind of err on the side of I don't think there's a lot of inflation. A lot of people here do think so. I actually can see totally valid reasons why both sides of the equation are true. The beauty of a house with a traditional 30-year fixed rate mortgage is once someone's into it, their monthly payment is locked in. Whereas someone who is renting, the rent typically goes up over time, as long as the economy is doing well. If the economy tanks, the rental rates may go down. But the fact of the matter is I also look at home ownership generally as a hedge against inflation. And certainly there's home repairs, and there's going to be inflation on the cost of hiring trades and getting people out to fix stuff or install stuff over time. Certainly there's some level of inflation on property taxes and such. But in general, the biggest expense with a home for most people is the mortgage, unless one pays all cash. That mortgage cost, if one does a traditional fixed rate mortgage, it's fixed over time. And so again, there's a lot of beauty in hedging away any concerns about inflation, which I think is especially important for someone who wants to live off of dividends, because inflation, it's the enemy of someone who wants to live off of dividends. And if a major expense in one's life can be generally hedged against inflation, I think it's a good thing. Now, one closing point on home ownership for dividend investors, it's a real weird thing. If you're a dividend investor, you don't own a home yet. Let's say you aspire to buy a home. The challenge here is when you buy your home, how are you going to pay for the down payment? Are you going to sell your dividend portfolio or a lot of it, like I've personally done in the past? Are you going to completely partition your dividend portfolio, have that separate, from the house and have a separate fund for down payment? How are you going to look at it? That is really critical. In my opinion, there's no one right way, one right answer. In that video I link in the description below from Las Vegas, where I talk about what happened during the Great Recession and is the crash coming, all that good stuff. I talk about this topic a little bit, so I don't want to repeat myself here. But in general, there are pros and cons of both ways. And so the one thing I would say is, now that I own a home, I am so blessed and so thankful that I don't envision myself facing a circumstance again where I'll have to sell part or the lion's share of my dividend portfolio. I can just build it from here. Whereas if I didn't own a house yet and that was on the horizon, it's never something fun for a dividend investor having to sell part or all of the portfolio or a lot of the portfolio to fund a down payment. I mean, there's pros and cons, but if you're trying to achieve financial freedom and you have a stream of passive income and you have to sell said stream of passive income to buy the home, which in some ways, according to some very popular authors and financial experts out there, is a liability, there's pros and cons. And so anyways, that's definitely worth noting, and definitely worth noting that 2018 is a lot different than 2013. This market is pretty lofty, especially around here. The prices are almost unbelievable, and so anyone buying now, in my opinion, should proceed in general with caution, as the prices of homes may go down at some point. Okay, so that was a great question. I really appreciate that subscriber question. Glad to answer it here because I think it's really timely for this market and for what's going through a lot of investors' minds out there. So question number 3, this is the last question for today's video to celebrate 14,000 strong. This one is about rebalancing a stock portfolio. So the question was, Ian, do you rebalance your portfolio? And my answer is no, I do not rebalance in a traditional way, at least. So what is rebalancing? Rebalancing to most stock portfolios or most investors, it means, hey, I have a bunch of stocks. If a few of them do really well and they get really big percentage of my of the portfolio, the investor will typically say, okay, I'm going to sell not all of it, but a lot of those shares, and I'm going to redeploy it into other stocks, the other stocks that might have not done as well. And the philosophy behind this is, one, by redeploying in the stocks that haven't done as well, hopefully those stocks, they are undervalued and they'll go up. They're going to do really well. And also it's just mitigation of risk. It's like, hey, there's too much money now in these stocks that have done really well. What if they come back down? And so, and I think for a dividend investor, the logical extension is if a stock went up a lot, why not take some of that capital, put it into stocks that have higher starting yields, and there might even be a way here to extract more dividend income out of one's entire portfolio. I actually did that recently with Dr. Pepper Snapple. I sold Dr. Pepper Snapple, a link in the description below, redeployed the money, and was able to, with the same money, was able to notch up the dividend income that comes from my portfolio. I rarely sell. I had very specific reasons here. Mainly because of the new combined company, I didn't want to own it. And quite frankly, there was a little bit of concentration that I had in the soda carbonated beverage industry, and so I did it. But I'll link in the description below. You can learn more there. But anyways, I took this money, bought more other stocks, and even factoring the taxes in, bam, dividend income, new level. Love it. So in general, however, the reason I do not rebalance my portfolio is severalfold. First and foremost, I don't want to penalize winners. Just because a stock is doing well, why would I want to sell it? A stock doing well, what if it continues to do well? What if it does much better? What if I'm up, Norfolk Southern, I'm up 152%. Should I sell now? Heck no. What if I'm up 300% in another 5 years? I don't want to cut myself short, and because I don't have a crystal ball, I can't tell the future. I never want to sell myself short. I think that's just so risky. And the other reason is I don't want to trigger taxable events. As I had mentioned before, I invest for dividends in individual account structure. And if a stock does really well and I sell it, taxes. If a stock does really well, I don't sell it. No taxes other than on the dividends coming in, which I'm very used to paying taxes already, very easy, very streamlined. And so I generally take a lazy approach. I generally take the approach that, hey, rather than selling something that's done well, one, I want to let it run, because what if it continues to do better? But if I feel it's gotten to a point where it's like just overvalued, I'll take pause. Oftentimes, I will decide not to reinvest dividends anymore. I'll take the dividends from that company, deploy them into another company in terms of buying new stock, because I'm always buying. I buy stock, buy shares of dividend companies every month. And I just wait it out. And new capital that comes in, I surely don't add it to the company that's really big. I shared this in a video recently on the Sin stock industry. I'll link in the description below. I've had crazy returns there, jackpot style returns, but these stocks still seem on sale right now. They're a pretty good deal. Am I buying now? No, I don't buy something just because it's a good deal. A lot of the time I do, but this segment is already overweight in my portfolio. I don't need more. And so for that very reason, I'm consciously, new money that I have to deploy each month, I'm not deploying it there. And so the way I rebalance, quite frankly, is lever number one, I decide not to reinvest dividends. I take the dividends, I reinvest them elsewhere. Lever number two is, even if the stock is a good value, I don't put more money there when I have more money to invest. I take my money and I put it elsewhere to rebalance, to keep something that's gotten just really big under wraps, because there is an inherent risk by having certain positions that are just too big in one's portfolio. And everyone's going to come to terms with target allocation weighting of each position. That's an exercise that I think is really important. It's just to know, hey, these are all the positions I own. I own 38, by the way. Here's, on a percentage-wise, how big this one should be, that one should be as a percentage of my overall portfolio. If it gets way bigger than that, okay, I'm not going to reinvest dividends. And okay, when new money comes in, I am going to put my money elsewhere until it's a little bit closer to its target weighting. I mean, there's surely going to be an exception from time to time. If something is just such a fire sale, such a deep discount, if it's over its target allocation, you'll find me breaking the rules. But that's what it's all about. You have to just use conscious judgment. Anyways, that's it, everyone. I want to thank you. I want to thank you for all of these fabulous questions. I want to thank you for being part of the community, for supporting the community, your likes, your subscriptions, comments, all of that. It really means the world to me. It is so encouraging. And the encouragement is coming not only on YouTube, but on all of my social media channels. I have questions coming in. I have people reaching out. I even have emails from time to time that are letting me know how valuable these videos are. Thank you, everyone out there, for that. It really means the world to me. And so before I end today, in celebration of 14,000 subscribers, I am going to be hosting a meetup sometime soon, probably in either October or November. It's going to be in San Francisco, and I'm going to be sharing more information on that soon, how you can sign up and how you can stay informed of the meetup. We're going to have a bunch of us. I already have a bunch of people who have written in the comments that they would like to show up. We're going to meet for coffee. We're going to talk about stocks. We're going to talk about dividends, cash flow, passive income, all the things that we enjoy so much. And so I'm really excited about that local meetup. So just earmark that. It's coming up. Stay tuned for my future videos where I will share more information on how you can sign up for that. So I'm really excited about that. And I ask you, if you enjoyed the video today, please check me out on Instagram. I'll link in the description below. Something I just shared on Instagram that I want to point out is dividends are pretty cool. And I love dividends. It's one of my passions in life. But dividends, they also need to have a higher purpose. And one of my higher purposes, at least, is giving myself and my family, we like to give back. And one of the charities we just donated to is called Musicians on Call. For the second year in a row, we donated money and sponsored a hospital room for an entire year. And what this means is for an entire year, a hospital room will be able to provide live music from really talented musicians, brand name musicians, to patients that are in need. And there's nothing like the healing power of music. It can uplift one's spirit. I know how important music has been in my personal life. It is always a motivator. And you guys know I like a lot of different types of music. I like rap music. I like jazz music in particular. Those are some of my favorite music. And so but boy, I'm so blessed, so excited to sponsor this charity in a meaningful way 2 years in a row now. And in fact, we recently donated money to a bunch of different charities. And so this is part of our greater purpose. You know, certainly I want to be able to enjoy my dividends and live off of them and use them to pay bills. But more than that, it's not just a means to an end for me to have a comfortable life or for me to enjoy life. I want to use dividends and personal finance and just having a really buttoned down financial strategy to benefit others as well. And so this is something that I've been thinking about a lot lately. And it's kind of that time of year. It's around this time of year each year that we do these donations. Well, typically, some of them I'm actually doing monthly. There's another foundation called the Guitar Center Music Foundation. I actually donate to this monthly, or I should say, donate to it monthly, my family. And this foundation actually gets musical instruments into high schools and musicians and middle schools, lower schools that cannot afford these instruments. And I know that a lot of the education in the music space has been just kind of put on the back burner in recent times when schools don't have enough funding. Of course, performing arts, they're not going to be the first choice for whatever funding is available. And so I'm so excited to help through that charity as well. And there's another number of other ones that we enjoy. I actually have a website where I document all of our charitable donations. I haven't updated it for a while, but look forward to doing that soon. I'll link in the description below if you guys want to check that out to see the types of charities that we love so much. But anyways, think about that. Maybe you're just getting started out. Maybe you're further along in your journey. Don't, maybe it's not charity for you. Maybe it's something else. But think, what's the higher purpose behind all of this? Surely the immediate purpose is paying bills, but there's other purposes as well. So before I leave today, in terms of full disclosure, I own the stock mentioned today. I am long. I own stock in Norfolk Southern, ticker symbol NSC. Also, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. This video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm literally just sharing my personal journey here on YouTube for fun and entertainment. Thank you again for watching. Thank you for subscribing. 14,000, everyone. Thank you. Thank you. This is so exciting, and I will see you in the next video.